To jest podcast System Trader, odcinek 38. A w tym odcinku mój gość, Jack Vogel, rozmawia ze mną o różnych podejściach do inwestowania własnego kapitału. Zapraszam serdecznie.
Interesujesz się inwestowaniem na rynkach kapitałowych? Szukasz swojego sposobu na oszczędzanie i pomnażanie pieniędzy? Zastanawiasz się, jak postawić swoje pierwsze kroki na giełdzie? Ponadto fakty, mity, wywiady i ciekawostki ze świata finansów. To i wiele więcej usłyszysz w podcaście System Trader. Zaprasza Jacek Lempart.
Inwestowanie jest proste, ale nie jest łatwe. To maksyma dobrze znana w świecie inwestowania. Owszem, technicznie inwestowanie powinno być proste, nawet bardzo proste. Ale niestety, ogromną przeszkodą jest nasza psychika i przeszkody, jakie kreujemy we własnym umyśle my sami. Wynika to z tego, że inwestowanie zawsze wiąże się z niepewnym wynikiem, nawet jeśli podążamy za najlepszą strategią na świecie. W tym odcinku Jack Vogel z firmy Alpha Architect opowie o kilku różnych anomaliach rynkowych, które nie tylko można zmierzyć i zapisać w formie jednoznacznych reguł, ale i wykorzystać w praktyce. Odcinek ten jest nagrany w języku angielskim i na chwilę obecną niestety nie mogę obiecać, kiedy pojawi się jego ewentualne tłumaczenie na język polski. Na pocieszenie dodam, że wiele tematów poruszanych dziś z Jackiem pojawiło się i będzie się pojawiać w przyszłości na moim blogu i w podcaście w języku polskim. Zapraszam serdecznie. Hello Jack, thank you very much for accepting my invitation to the podcast. Many people for sure already know you, either from your books or multiple SSRN papers. Could you please, however, introduce yourself, especially in the context of financial markets career?
Yeah, well, thanks for having me on, first off. So, introduction about myself. I started in finance. I originally was in graduate school, getting a PhD in math, and realized I wanted to change, and I was very intrigued by finance, and got drawn into PhD in finance program at Drexel University in Philly. And that's where I met Wes. Wes is the founder of Alpha Architect firm I work at now. And I've been working with Wes since 2010. So originally did research with Wes at Drexel, and near and at graduation decided to move into the practitioner world as opposed to staying in academia.
Right, I understand. Thank you for that. The majority of investors cannot beat the market in the long run, and we have a kind of paradox that everyone would like to beat the market, but the reality is different. I mean, investment results are most often below the market average. And it's not only a problem for the, let's say, retail traders, but also a problem for professional investors working for funds, for example. And do you think it's still wise to try to beat the market if it's so hard to achieve it?
Yeah, that's obviously a great question. I think that, for a decent amount of people, if you're going to compare your strategy year over year or every 6 or 3 months to the market, I would recommend that you probably just invest in the market. We've had a decent number of people that have come across our site I've discussed with who would look and say, hey, value's losing to the market over the past month. Is it broken? And for those investors, I definitely think, investing in the market is a great place to start. And actually, for most investors, just investing in the market is a great place to start. I still do believe that there may be some systematic strategies that can work over the long run, but that doesn't mean they're necessarily for everyone.
Right, I understand. But if you say that basically there is a way to beat the market, so the markets are not efficient, as some theorists try to say, what kind of anomalies you think are giving us potentially the greatest edge, in your opinion?
Yeah, so we're fans of factor investing, and of the factors, we're big fans of value and momentum. There's other factors like quality, profitability, low volatility. They're all decent factors. We still think, value and momentum of the factors are the two ones we prefer to focus on, and the two ones we think can work long term. And then, you can ask why. Well, one thing is, because we get this question a lot, well, is it broken, right? Because recently some factors have underperformed. And one thing to note is that, it actually has to be the case that the factors can't work all the time, because if they worked all the time, then it would be easy for everyone to just invest in it, and that edge would go away pretty quickly.
Okay. And what do you think, for example, about tactical asset allocation? I mean here, let's say a pie chart investing, where a portfolio has a fixed allocation to some assets. And for example, Ray Dalio's all-weather portfolio, or Warren Buffett's 90-10 portfolio, as Warren Buffett, for example, said that the average investor, and actually what he is suggesting to his wife, if he passes, that to put 90% of the money into stock index fund and 10% into short-term government bonds. What do you think about such strategy? Because it sounds very easy, but how looks the reality from your point of view?
So I guess from the investor's perspective, it just depends on the behavior that you're going to have, right? So Warren Buffett, his foundation, if the market goes down 30%, 40%, I don't think their life gets affected whatsoever, right? When you have that much money, I think it's easy to just stay in the risk asset. If it goes up, great. Goes down, who cares, right? So I think when we start talking about individual investors, whereby they don't have a couple multiple billions of padding on their security, they can be a little more risk averse than maybe like a 90-10 portfolio. But for some investors, that actually is I would say, an okay place to start, because maybe they're very reticent to put money in government bonds, yielding 1.5% or 2% or negative. I think it varies from investor to investor in aggregate.
Right. But do you think then that maybe rather than to focus on trying to beat the market, an average investor should rather to focus on how to decrease the maximum drawdowns during that investment period? So let's say that on average the market makes 8% per annum, but if in the meantime we had drawdowns, like you said, 30 or even more percent, then this is what is really making the whole thing very difficult for an average investor, and these investors should rather focus on decreasing that drawdowns rather than beating the market itself.
Yeah, so we actually are advocates, and we like trend following rules, which is one way that you could try to reduce drawdowns. Right. And again, trend following simply, there's two ways you could do it. You could do what's called time series momentum, whereby if the return, you just measure the return over a preset period, such as a year or 10 months, compare that to zero or risk-free rate, and if it's greater, you stay invested. If it's not, you get out. Another way is moving average rules. And so, trend following using either of those rules is one way to try to reduce the risk at times in the portfolio in an attempt to reduce drawdowns. The downside of that is it's not going to work all the time. But for a lot of investors, if that allows them to actually invest in the asset class, it's probably better than just sitting in cash.
Right. You have a background in mathematics, so of course, obviously, for you having abstract models, it's something, let's say, natural. But do you think that also for an average investor, it's better to have a systematic approach to the market? So, as you said, to have a simple but very exact rules, rather than to try invest in a discretionary way.
Yeah, I would generally agree with that. Models, parameters, they're generally good. I'll give you two examples. One is just, let's pretend you're a simple buy and hold investor, right? And you start out with a 60-40 portfolio. Well, at least for the past 10 years, if you didn't have some parameter saying that you needed to rebalance back to 60-40, when your target weights got out of bounds, let's say maybe 10%, just making this up. But if you didn't do that, all of a sudden, in 5, 6, 7 years, you're going to be 100% equity investor, right? So even for your standard buy and hold investor, parameters, simple models are helpful. Now for someone using possibly like a trend following strategy or momentum strategy, one of the reasons, and a reason that we advocate using a systematic approach to stick with when you rebalance, what the rules are, is just the human behavior that comes into play. So it's it would have been pretty easy in possibly, I would say maybe January of this year to look and say, hey, even though our trend rules triggered in December or January of this year, now it's beginning of February, there's a ton of market volatility, but our rule says to get back in. Well, if you didn't get back in, you would have been hurting yourself. So systematic rules, I think, are a good place to start for most investors.
Okay, and would you agree that having systematic rules applied for long-term approach investment rather than short-term approach, it may be easier just for an average investor as well? Because let's say that what happens every day is from the point of view of a long-term strategy is just a noise. So would you be able to say that indeed it's better to focus on long-term approach?
Yeah, I would say systematic probably works in both, right? Because, if you're like a short-term trader, you probably want to have rules and bounds. And, if you're just making trades here and there, you don't want to bet too much of your book on one thing. But for long-term investors, I would agree, systematic strategies definitely help.
Right. I would like to discuss now some alternatives to pure passive investment approach or to tactical asset allocation. And I'd like to start with a momentum anomaly, which was already mentioned. Could you please explain what is momentum, why it works, and will it continue to work in the future?
Yeah, so momentum is, it can be defined in a couple ways, but high level momentum is the fact that at the intermediate term level, so basically looking past 6 months to 15 months, if you look back at returns of asset classes, stocks, bonds, so we'll simply stay with stocks. So if you stayed within stock universe, look back over the past year, the momentum anomaly is the fact that the winning stocks, those that did the best over the past year, continue to win, whereby the losing stocks, those that did the worst over the past year, continue to lose. So at a high level, just within our stock example, that is the momentum anomaly.
And what do you think is the mechanism behind that the momentum works? Because, for example, if we will look on value investing, there we would rather look for some, let's say, bargains on the market. So we are looking, for example, for something which is, let's say, cheap. Whereas here, momentum says buy if something already is, the price already increased, and just buy this, the stronger stock.
Yeah. So there's, general in academia, they try to figure out why things work. And the two main arguments here are it's a risk base. Essentially, momentum stocks have an embedded additional risk as opposed to just the broad market.
Right.
And where do they get that? AQR is a decent paper, basically titled Explanations for Momentum Premium. And what they find is that momentum stocks have like a strong correlation structure, which in general is how Thom and French came up with the risk-based argument for value and size, right? So one thing is it could be that momentum stocks are riskier. A second case, which most investors, I think, like this explanation better. I'm not sure which one it is. It's hard to tease them out. But the second case is a risk-based explanation. And this one kind of makes sense at a high level. It's, when good news comes out about a high momentum stock, people tend to underreact to it. So, the price doesn't go up as high as it probably should. And alternatively, on the flip side, when bad news comes out about low momentum stocks, people tend to underreact, right? Which allows for like the continuation, right? If you underreact on both sides, then there should be a continuation of both positive for high momentum stocks and negative for low momentum stocks.
Right. And as we know from the history that momentum works, many people are probably interested, will it continue to work? I mean, if it's an anomaly which is broadly known, do you think that at some point it may just stop be so effective just because too many investors will try to follow strategies based on momentum?
Yeah, that's a great question. So, one reason I think it will continue to work, is, there's multiple types of momentum. So first off, on a stock-based level, and we're going to talk about this in a little bit later, but, the how much capacity a strategy can take on definitely is going to vary, from, your baseline assumptions, but I still think there's definitely capacity there. And then the other thing is, as we talked about, and we'll talk about in a little bit, there's different types of momentum, such as like asset class momentum and other types of momentum, whereby a lot of investors kind of have static type portfolios. And so, in general, if you just invest in the broad market, you're 50% US, 50% international, whereas a asset class momentum trader can say, hey, I'm going to go from US to international. And those two markets are pretty liquid, and there'd have to be a lot of money after that for it to be completely arbitraged away, is what I'd have to say.
Okay, thank you, Jack. What are the types of momentum? You already mentioned the momentum where we compare one stock to the other, but there is another type of momentum. Could you please explain so that everyone knows that momentum is a broader term?
Yeah, so momentum and actually value, and this is why we're fans of those two strategies, but I'll focus on momentum. One thing you always like to see within a strategy or some sort of systematic approach that you're taking is that it happens to work in like multiple markets across different time periods and different ways you measure it, right? And so a great paper that I'd recommend everyone read, it's called Value Momentum Everywhere, which is another AQR paper, but they test momentum in multiple asset classes. So within stocks, within stock futures, within bonds, within commodities, right? So within multiple markets, and what they find is that momentum as well as value tend to work in all of these asset classes. So one of them, which I mentioned, was stock futures, which is, maybe if we look at US versus ex-US or US versus a combination of other equity futures around the world, they found that momentum worked there, whereby the winner kept winning, the loser kept losing.
Right. So in general, as you said, also momentum works on different asset classes. It doesn't have to be just a stock market. It can be, other market as well. I don't know, gold or whatever. This anomaly is also existing in other asset classes. Gary Antonacci introduced so-called dual momentum strategy, actually dual momentum approach, where he is using both types of momentum. The absolute momentum and the relative momentum. And as far as I know, you also know Gary Antonacci's approach. And because I have already had Gary Antonacci on my podcast, and this podcast episode was pretty popular among listeners, I would like to ask you what do you think about dual momentum approach, and how do you see that from a practical point of view for an average investor?
Yeah, good question. So yeah, we've known Gary. I've known Gary for years. Done some speaking things with him. Wes, actually, the founder of our firm, he wrote the intro to Dual Momentum, the book. So we know Gary pretty well. What I'd say, and let me just clarify so all the listeners understand. So Gary's dual momentum talks about, momentum across asset classes. So like US versus ex-US, right? High yield versus treasury. So we consider that to be momentum. And then he talks about absolute momentum. We consider that to be trend. So I'm just going to, just so we don't get confused here, momentum we'll classify as, comparing A and B, and trend is kind of, are you going up or down? Now getting back to your question about dual momentum, we're advocates of value investing, momentum investing, and then we use trend as well. So dual momentum at a high level just is doing two of the three items that we are fans of. So it's doing momentum investing, i.e. are you investing in, like for his simple equities momentum, it's are you in US or ex-US? So that's momentum. We're a fan of that. Then basically there's the trend component. is the US or ex-US trending up or down? If it is, we're invested. If not, we're getting out. So, I would say I, at a high level, agree with Gary's approach. It's different than what we do, but for a lot of investors, it's a fairly simple and neat approach to investing.
Okay. And by the way, Gary is fan of applying momentum to stock index rather than to the to individual stocks. And he even says that he says that in his book, and he also mentioned about that in the interview with me, that index has, let's say, the advantage of greater scalability and lower transaction costs if to compare to individual stocks. Could you please comment on that? Because also it seems that it's easier to trade on the whole index rather than individual stocks. But how would you comment that?
Yeah. So what I'd say is the two statements you just said are 100% true. Is it more scalable to trade high momentum stocks or trade the S&P index? 100%. It's going to be the S&P index, right? So that's a true statement. Is it easier to trade the S&P versus high momentum stocks? That's a true statement. Now, we still think that there happens to be an ability and capacity to earn additional returns in high momentum stocks relative to the index. But, that's just a disagreement that Gary and I think have. And part of that has to do with, what your assumptions are on trading costs. So I wrote a long article about that, and it goes back and forth. Academics have models, practitioners have models, and I think it's an interesting article for everyone to read. I do think some of the academic models on transaction costs may be misspecified. A good example of why it could be is if you use the academic model for transaction costs, you would say that for Vanguard to rebalance their S&P 500 fund costs 65 basis points. But when you ask them or iShares how much it costs to run and how much their net cost is to rebalance the S&P 500, they say 6 or 7 basis points. So, the academic model may be off by a magnitude of 10 on transaction costs, which is pretty big in my opinion.
Okay. Thank you for that. By the way, you mentioned about the rebalancing, and in general with the models, we have, let's say, the problem that we have to say how often to rebalance our portfolio. But what do you think about ideas going around now that you should or we could use several rebalancing periods, so-called tranching, rather than just one fixed period that, let's say, once a month, once a quarter. So rather than doing that at once, just to split this into a few days, for example. And also, for example, how many different parameters values to use at the same moment, for example, look back periods. How do you see this idea?
Yeah, good question. So there's, decent number of articles now saying, hey, what if we took Gary's strategy, Jim? Mm-hmm. There's some by, Newfound Research, Corey Hofstein, the Resolve guys up in Canada. Good articles, worth reading just for understanding. And what I'd say is I don't think there's a clear answer either way. One of the benefits of tranching and using multiple signals is, given that we have a assumption that the market beta, I'm just going to use like trend here I'm not talking about the momentum signal, but just pretending that our trend signal is going to tell us to get in or out of the market, using multiple signals going to kind of smooth out those returns, right? Possibly, but it can add in some complexity. And, I do think, and I'm becoming, the more I'm in this, I think the investor behavior becomes very important at a high level. So for an individual investor who may say, hey, I want to do this, and I like the simple rule of, I'm going to look at it, once a month. I'm going to use one, maybe two rules, and I'm going to go with that. And if they're willing and able and can stick with that, then that's a great strategy. If someone says, hey, I don't like this all or nothing 0-1 type approach. I'd rather be scaling in, scaling out. that's fine. The scaling in, scaling out could have some additional trading costs just due to the fact that, you're at times you're going to have more signals which are going to tell you to trade both ways. So I don't know if there is a exact correct answer is what I would say. I don't know if I really answered that, but I don't think there's a perfect answer at a high level would be my takeaway.
I understand, because could we look at this problem that if we use tranching or we use multiple parameter values, in fact, it's like we would use multiple strategies which are highly correlated. Okay, it may happen that, as you said, one parameter will say to leave the market, another one will say to stay in the market, but in the long term, probably these two strategies actually will be highly correlated. So would you say that maybe, especially for a smaller investor, it would be wiser to try to add to a portfolio some other strategy which is not correlated to the first one, rather than to use tranching, for example?
Yeah, well, so tranching is just going to create, as you highlight, very highly correlated type strategies, right? Because if you believe, like, you're essentially using the exact same rule. You're saying, hey,
Right.
we believe that the equity risk premium is dynamic, right, as opposed to static. And at times we want to get out of it because we think it's negative. At other times we think it's positive. So you're going to have very similar strategies. The one thing that'll happen is, in a 1 year period, you can have, pros or cons. So for example, let's just say, and here's one of the biggest downsides is, an individual investor uses like 2 rules or 3 rules, right?
Right.
And then they keep switching back and forth. So, and for example, last year, maybe the 10-month rule worked well because it worked great in the fourth quarter, but the 12-month rule didn't work. And then all of a sudden, the investor starts changing around and says, hey, the 12-month rule is broken, because your mind's just going to possibly see patterns that may or may not exist. And so I guess that's one downside. Now, what you mentioned about adding in a strategy that is kind of uncorrelated, that's another way that would definitely help, as opposed to doing the same strategy just 100 times. You could do, one simple strategy, and then maybe just like a simple asset class momentum strategy, which is another way to try to reduce drawdowns, but now you're going across like stocks and bonds based on what's doing better.
Okay, so for example, if you have a momentum strategy, you've mentioned already a few times about the value investing. Do you think that momentum could be useful for value investors as well? I mean, could you maybe even provide some example how we potentially could combine these two factors? I mean, the momentum and value.
Yeah, so at the stock level, one of the interesting facts is that value and momentum happen to be negatively correlated, which is a very neat finding. Essentially, when value does well, and again, this is examining the long short portfolio, right? So that's like pretty much the exact thing that you want. You want to have 2 factors or 2 return streams that, in expectation, at least in the past, but in expectation, have positive returns, but they have negative correlation. So at some level, if you're just a deep value investor, momentum stock selection investing is probably the best thing you can add to your portfolio. And so how would one go about that? Well, in general, not everyone does long short value momentum, but, long only value momentum are going to have a positive correlation, but it's way lower than value in the market or momentum in the market. So simply combining the two, in general, is going to really help out a value investor.
Okay, thank you, Jack. So just to complete this discussion about the momentum, I have one more question on GEM strategy. Actually, I should have asked Gary, how do you think GEM can behave in the era of near zero or even negative interest rates? Because this strategy is switching between the equities, the stock markets, and the bonds, if the stock market is on the negative side. And then if we are near zero about the interest rates, it can happen that we will be in the era of rising interest rates. So how do you think GEM can behave in such environment?
Yeah. So what I'd say is, first off, I guess maybe do two assumptions. One is just interest rates stay the same, right? So, in such an assumption there, what is, your interest rates both on your cash and your bonds are going to be lower than historically what they would have been, right? So being in bonds, assuming the risk premium, which, you can measure and kind of project what you believe that to be, but, being in stocks when cash and bonds are yielding lower amount can be beneficial. But as you know, there can be downside, which is, bigger drawdowns in your portfolio. So, if interest rates stay the same, hopefully your return, even if, the trend doesn't work that well, is well above what the return to bonds would be. Now, the one nice thing about, if interest rates are rising, maybe in an inflationary type period is, if you do dual momentum or you use momentum not only on equities, so basically, US, ex-US, are you in, are you out? But also on bonds, you could say, if you're in bonds, are you in long or short-term bonds? So it's a little bit more dynamic on the duration side, which can be beneficial if interest rates are rising. Because, if interest rates are rising, you probably don't want to be too far out in duration in such a case.
And do you think that maybe Treasury inflation-protected securities tips could be helpful in the rising interest rates? I mean, if we will have a inflation.
They could be. Again, an alternative is to simply just go shorter on duration, do like
Right.
1 month T-bills.
Right, I understand. So just to avoid the risk in duration.
Yeah,
Okay.
at times.
Okay, thank you. All right. I'd like to just very quickly touch another type of anomaly, namely mean reversion, because quite often some say that on one side we have momentum, but on the other, so basically if the stocks are going up, the market, then if it was up within the last year, for example, then it tends to go higher. But on the other hand, we have the mean reversion, which is kind of, let's say, the opposite. Could you please explain quickly what mean reversion is and how we could even compare it to momentum, to autocorrelation?
Yeah, good question. So on mean reversion, it's actually an interesting fact. So we talked earlier about momentum, like within stocks. And I specifically stated within intermediate momentum, which is kind of, from 6 months to 15 months, we see what's called a continuation. Winners keep winning, losers keep losing.
Right.
An interesting finding is that at the short-term level, like 1 month returns, as well as long-term, such as 3 to 5 year returns, we see reversion, right? So for short-term trades, or short-term momentum, what we see is past month's winners actually do poorly this month. Past month's losers do well this month. Same thing happens at the long end when we go out for 3-year momentum or 5-year momentum. Now, academics on the 3 and 5-year momentum basically say, hey, this is value investing, right? You're buying the cheap stocks. So that's kind of how they explain the long-term reversion. And then on the short-term reversion, I think that's almost more of like a trading strategy, right? This is kind of a month-to-month, week-to-week rebalance whereby, winners do poorly, losers do well. That's probably embedded now in like market-making trading type strategies. So two different ways to look at mean reversion. One is on the short-term like trading type side.
Right.
Another way is basically be a value investor.
Okay. And regarding that first time, do you think that the short-term mean reversion could be a good add-on to the portfolio, which is already using some strategy based on momentum?
So it could be. What I'd say is, shorter-term mean reversion, if things get overrun, is possibly at some level I kind of consider that to be almost like a trading strategy, right? You're not buy and hold in it. You're just going to be kind of in and out. And an interesting thing about trading strategies, which is not what we discuss as much on our website or we do research on. But one thing about trading strategies is they're definitely going to be different than a buy and hold strategy, right? Because trading strategies, you're going to be going long, short, trying to just make money real quick in and out. And a true fact is as opposed to a buy and hold portfolio, a trading strategy that goes in and out real quick is definitely going to probably be uncorrelated to a more of a buy and hold portfolio. So it can add value, but I would just be wary of, I think investors should understand what that strategy is before they go into it.
Okay, thank you for that, Jack. Okay, we are reaching to the end. I have just one more question. Would you be able to say what personality traits you need to have to be a successful investor, no matter if it's a momentum or value, whatever, just to be a successful investor, and especially investor who is following some systematic approach?
Yeah, so I've been doing this now since 2010 with Wes. We've been managing money since 2012. One thing I would say is I think it's really important that the investor kind of they don't have to understand the nuts and bolts detail of everything, but the strategy needs to align with their behavior, right? So, I come from an academic perspective, and one thing I've noticed is, if you read academic papers, they don't really talk too much about dividend investing, right? Because to an academic, dividend investing is what? It's just a value quality type portfolio, right? So you're like, oh, okay, well, I can just go buy a portfolio that has a value loading of this, a quality portfolio of this. But there are some investors who are dividend investors who can be the happiest people of all time because all they do is invest in slightly higher dividend paying stocks and live off the dividends. Mark goes up, they don't care. Mark goes down, they don't care, right? So I would say the same thing goes for more tactical strategies. You need to understand up front what are the pros and cons of it. So a dividend investor knows that, hey, I'm investing in dividend stocks. They may lose to the market. They know that up front. They know that, companies can cut the dividends, but they've just decided to live with that. So for a trend type investor or a dual momentum investor, what's your biggest risk? I think the biggest risk on anything that embeds trend is that at times your trend rules are going to not work, right? And here, so like a good example is past 10 years. And I'll send you a link afterwards, but I had a post and basically talked about how trend following is done poorly, especially in equities over the past 10 years. So real quick, from beginning of 2009 to the end of 2018, a full decade, buy and hold S&P was up 13%. US with trend following, again, a simple rule, was up 8.5%.
Right.
So you lost by 4.5%. And for a lot of investors, that can be an issue because they may say, hey, well, I could have just bought the market. And if you're an investor who is always going to compare your portfolio to the market, then you should just invest in the market. So I think the behavior is the biggest thing, and kind of understanding what you kind of believe in and what you're willing to do. Now, on the flip side, people have noted, because I didn't really explain in this article, but a U.S. trend investor earned 8.5%. But if you were just investing in bonds, you only would have earned 3%. And if you were in cash, you would have earned 35 basis points annualized. Right. So you still would have done better. But again, if you're going to just constantly be comparing yourself to, the S&P 500, well, at some level, then you already know the answer, which is just invest in the S&P 500, right? If you're an investor who says, hey, I want to invest in stocks, but I'm reticent towards large drawdowns, well, with trend following, a potential downside is it doesn't work all the time. So I think understanding your own behavior and how you're going to react is probably one of the most important things that are required to be a successful investor, specific to a trend-based strategy.
Right. Even Warren Buffett, by the way, is not always beating S&P. So we shouldn't be too much worried if in a given period of time our strategy is also underperforming. So basically, if we could summarize, the discipline is the key. Just to stick with the strategy and religiously follow it.
Yeah, I would say that, but again, assuming that's what you kind of believe in. Like if you just believe that, the market is the market and you're going to get your returns there, then maybe you should just do that, right? And interestingly enough, as you mentioned, Warren Buffett, he's holding a ton of cash, right?
Right.
If he was just, if he had just put it in the S&P 500, his returns would have been a little bit higher.
Right. Okay. Jack, do you have any recommended books, or maybe papers, maybe blogs, podcasts, which you would really recommend to the listeners?
Yeah. So, one is definitely the AQR Value Momentum Everywhere.
Right.
And I'll send you a link there. I think it's a great paper.
I'll put it on the side. Yeah.
Yeah. The one that I think is important for anyone looking at more tactical trend portfolios is the one I wrote recently, that trend following a decade of underperformance, just to highlight, that it can it not work at times. Obviously, it does work when you have 50% drawdown, but at times it's not going to work. But we'll start with that, and I may have a couple other ones I'll send you afterwards.
Okay. Is there anything else you'd like to add before we will finish today's podcast?
No, I mean, I think, momentum investing, which is, essentially buying winners, not buying or shorting losers. In general, most people just do the buy winners. I still think that can work in the future. It's not going to work all the time, which at some level is a good thing, right? If it worked all the time, it would be arbitraged away pretty quickly.
But if someone would ask you and put the gun to your head, momentum or value, which one you would choose?
That's a tough one. I'd probably have to still go with momentum. I'm definitely a value investor at heart. You want to buy like cheap stuff. I think that's just natural for most people, right? Everyone likes a good deal. But momentum just, in a lot of things in life, teams that are doing well in sports continue to do well. Yeah, I just think of those premiums, momentum will probably be the highest.
Okay. Thank you for that. If someone would like to contact you, the best way is just through the website, or maybe some other means of communication you could suggest?
Yeah, they can just shoot a note through our website, which is just alphaarchitect.com, and just mention, hey, listen to you on the podcast and have a question or want to discuss something.
All right. Jack, thank you very much for valuable information you provided to us today. Thanks a lot and have a good day.
Thanks, you too.
Thank you. Bye-bye.